Every single time in history, the Federal Reserve has cut interest rates. Three things happened in a very specific order. First, most people celebrated. Second, the wrong people made money. Third, everyone else figured out what actually happened about 6 months too late. I have spent the last 3 weeks going through every Fed cut cycle since 1995. The price action, the winners, the losers, and what I found is going to change how you think about the next 90 days completely. By the end of this video, you will know exactly which side of this trade you want to be on before the announcement, not after. You are watching Macro Signal, the only place that tracks where smart money moves before the mainstream catches. Before anything else, I want to tell you something personal. 6 months ago, I had most of my liquid savings sitting in a high-yield account, earning 4.2%. I felt smart. I felt safe. I told myself I was being disciplined, waiting for the right moment to deploy. Then I started doing what became this channel. And I realized I was not being smart. I was being slow. The right moment I was waiting for was already being priced in by institutions 3 months before I even started looking. That moment cost me real money, not because I made a bad decision, but because I made no decision at all. And that is the trap this video is going to pull you out of permanently. Let's talk about what a rate cut actually is. Because the media will frame it as good news, and it is not. When the Federal Reserve cuts interest rates, they are not doing you a favor. They are responding to something breaking. Labor market data in early 2026 has been telling a very uncomfortable story. February came in at negative 92,000 jobs. That is a contraction, not a slowdown. March recovered slightly to positive 65,000, but that is still less than half of what a healthy economy produces in a normal month. The Fed has seen this data. Their own projections for 2026 growth have already been revised downward. A rate cut is coming. Fed funds futures are currently pricing in above 70% probability of a cut by July. And the moment that cut happens, a very predictable chain of events begins. The first domino is cash. Your 4% savings account does not survive a rate cut cycle intact. In 2019, the Fed cut 3 times between July and October. By December of that year, the average high-yield savings rate had dropped from 2.4% to 1.7%. Banks moved within weeks, not months. In the current environment, with inflation still running at 3.4% as of Q1 2026, a savings rate falling toward 2.5 or 2% does not just underperform. It locks in a guaranteed real loss every single month. The people who feel safest right now, sitting in cash, are the people who are about to feel the rate cut most painfully. Not dramatically. Not all at once, quietly, every month, until they look up and realize their purchasing power has been bleeding out for a year. The second domino is stocks. And this is where the dangerous optimism lives. Every financial headline after a Fed cut will say some version of markets rally on Fed pivot, and for 2 to 3 weeks, that is often true. Cheap money feels good. Borrowing costs drop. Sentiment improves. But here is what those headlines never show you, the 18 months that follow. In 2001, the Fed started cutting in January. The S&P 500 fell 49% over the next year and a half. In September 2007, the Fed cut for the first time in that cycle. The market peaked 1 month later, then lost 57%. The rate cut was not the solution. The rate cut was the confession that something was already seriously wrong. With 2 consecutive months of labor weakness already on the books in 2026, The question is not whether the economy is slowing, it is how far that slowdown goes. Long-term index investing still belongs in your portfolio. But deploying fresh capital into broad equities, right at the moment the Fed signals economic distress, is not a strategy. It is hope with a brokerage account. The third domino is gold. And this is where the data gets precise enough to actually act on. In every Fed rate cut cycle since 1995, gold has risen an average of 6% in the 4 months following the first cut. In cycles where recession fear was the primary driver, minus 2001, 2007, 2019, that average climbs to 11% in the same window. The mechanism is straightforward. Gold pays no yield. When your savings account pays 4%, holding gold costs you something real. When that savings rate collapses to 2% after a cut, gold's zero yield suddenly becomes a much smaller sacrifice. At the same time, rate cuts weaken the US dollar, and a weaker dollar means gold becomes cheaper for every buyer outside America. Central banks in China, India, Poland, and Turkey are not buying gold because of sentiment. They are buying because they are diversifying away from dollar exposure at the fastest pace recorded since 1971. That buying does not stop because the Fed moves. It accelerates. Now here is what makes this specific moment different from any other point in the last 2 years. Gold already crashed 23%. From $5,595 per ounce at its peak down to around $4,300 in a 60-day window. Every comment section on every finance channel called it the end of the gold bull market. But Goldman Sachs did not lower their year-end target. JPMorgan did not lower their target. Wells Fargo did not lower their target. Goldman is at $5,400. JPMorgan is at $6,300. Wells Fargo is between $6,100 and $6,300. These institutions looked at a 23% crash and kept their price targets unchanged because they understood what caused the crash. It was not fundamentals. It was forced liquidation, leveraged traders getting margin called out of their positions all at once, creating a mechanical selling wave that had nothing to do with gold's underlying value. The moment the last forced seller was done, the fundamental picture was identical to what it was before the crash. Dollar debasement, deficit spending at $1.5 trillion per year. Central bank accumulation, recession risk rising, and now a Fed rate cut coming directly into that setup. The window between now and that first cut is where positioning happens. Not after the headlines, not after gold moves back through $5,000 and suddenly everyone is talking about it again. Right now, in this quiet period where most people are still debating whether gold is dead, this is exactly the setup institutional money waits for. A crashed price, unchanged fundamentals, and a catalyst on the calendar. You do not need to be sophisticated to act on this. A gold ETF GLD or IAU trades exactly like a stock inside any standard brokerage account. You can start with $100. You can start with $50. The size matters less than having a position before the move rather than chasing it after. The single most expensive financial habit most people have is waiting for certainty before acting. Certainty comes after the price has already moved. The people who built real wealth in every cycle did not wait for the Fed to cut and then buy gold at $5,500 while it was trending on social media. They bought at $4,300 when it felt uncomfortable, when the comment sections were calling it dead, when the 23% crash had scared everyone else out. That is the moment macro signal exists to identify, and that moment is right now. If this breakdown changed how you see the next 90 days, then you already know this channel is different. Subscribe to Macro Signal right now. One click, completely free, because next Wednesday we are covering the one economic indicator that has predicted every major gold move in the last 25 years, and what it is currently signaling for the second half of 2026. That is a video you want to see before the Fed meeting, not after. Subscribe to Macro Signal now and hit the bell so Wednesday's video comes straight to you the moment it drops. And before you go, tell me in the comments exactly where your money is sitting today. Cash, stocks, gold, crypto, whatever it is. Drop it below. I read every single comment personally, and I reply to as many as I can. Your answer shapes what Macro Signal covers next, so let me know right now.